Welcome to the jungle. What is the stock market? The stock market sounds intimidating? It doesn't have to be. Think of it as a giant flea market, but instead of used furniture and vintage clothes, companies sell pieces of themselves. These pieces are called stocks. By buying stock, you're essentially buying a tiny ownership stake in that company. Why would companies do this? To raise money, of course. By selling shares, they can fund new products, expand operations, or hire more people. And where does all this buying and selling happen? That's where the stock market comes in. It acts as a platform, connecting buyers and sellers of these stocks. It's a dynamic, ever-changing ecosystem where the collective actions of millions of participants determine the price of a company's stock. It's a thrilling, sometimes terrifying, but always fascinating world. So, let's talk more about these stocks. They're essentially tiny pieces of ownership in a company. When you buy a stock, you're not just buying a piece of paper, you're buying a piece of that company's future. If the company does well, its value goes up, and so does the value of your stock. You could potentially sell your stock for a profit. Conversely, if the company falters, so does the value of your stock. It's a risk-reward scenario, just like most things in life. But stocks aren't the only game in town. There are also things called bonds. Think of bonds like loans you give to a company or government. They borrow your money and promise to pay it back with interest. Stocks are considered riskier than bonds, but they also offer the potential for higher returns. Bonds, on the other hand, are seen as less risky, but offer more modest returns. It's all about finding the right balance for your investment goals. Let's delve a bit deeper into the world of bonds. When you buy a bond, you're essentially lending money to a corporation or government. In return for your loan, the issuer promises to pay you a fixed interest rate over a predetermined period, and to repay the principal amount when the bond matures. Bonds are often seen as a less risky investment compared to stocks. This is because bondholders are creditors and get paid before stockholders if a company goes bankrupt. However, this lower risk profile also typically means lower potential returns compared to stocks. There are different types of bonds available, each with its own risk and return characteristics. Government bonds, for example, are considered relatively safe, while corporate bonds tend to carry higher risk but also offer higher potential returns. Section 4, where the action happens, trading floors. Now, you might be picturing a chaotic scene when you imagine where all this buying and selling takes place. You wouldn't be entirely wrong. Traditionally, trading floors were bustling hubs of activity, filled with traders shouting orders and making deals at lightning speed. Imagine a sea of screens displaying real-time market data, phones ringing off the hook, and the constant hum of financial transactions. It's a high-pressure environment where split-second decisions can mean the difference between making a fortune and suffering a significant loss. This is the image portrayed in countless films and TV shows about Wall Street. However, the rise of electronic trading platforms has significantly changed the landscape of trading floors. Today, much of the trading activity occurs online, with algorithms and automated systems executing trades at speeds unimaginable to human traders. While the physical trading floor may be losing its prominence, it remains an enduring symbol of the fast-paced and competitive world of finance. Section 5, the heart of the system, stock exchanges. Now, where do these trading floors, whether physical or virtual, reside? The answer is stock exchanges. These are the institutions that facilitate the buying and selling of stocks and other securities. Think of them as the organizers of this grand financial marketplace. Some of the most well-known stock exchanges include the New York Stock Exchange, NASDAQ, and the London Stock Exchange. Each exchange has its own set of listing requirements and regulations that companies must meet to have their stocks traded. They act as gatekeepers, ensuring a certain level of transparency and fairness in the market. Section 6. Why it matters, your stake in the market. So, why should you care about the stock market? Even if you have no plans to become a day trader, understanding the basics of how it works can be beneficial. For starters, your retirement savings are likely invested in the stock market. Knowing how your investments are performing and the factors that can impact their value can help you make more informed financial decisions. Moreover, understanding the stock market can provide valuable insights into the overall health of the economy. The stock market is often seen as a leading indicator of economic growth or decline. When the market is doing well, it's generally a sign that businesses are thriving, Unemployment is low, and consumers are confident. Conversely, a downturn in the market can signal economic troubles ahead. While it can seem complex at first glance, the stock market is simply a mechanism for companies to raise capital and for investors to participate in their growth. By demystifying this crucial part of the financial system, you can become a more informed and empowered participant in the global economy.